Philippe. It's very nice to have you here in Berlin at the Berlin Green Investing Summit. You're a pension fund manager. Can you tell us more about your background and your job there?
Yeah, I have been the CEO of ERAF, a pension fund for French civil servants, responsible for the management of 30 billion euros of assets that are matching our liabilities. And those assets have to be resistant to what's happening in the economy, and especially to this climate change that nobody can really contest now. And it's the reason why I'm so interested to participate in this event and by the project of the climate endowment. It's unfortunate that pension funds have been meeting difficulties to invest much more in infrastructure and all the projects that will contribute to reduce the risk associated to climate change. And I think developing some sort of endowment would be a response to those difficulties pension funds have met in addressing, this asset allocation to climate solution and climate project.
Why is a new vehicle needed? Why can't you do it out of the existing ones in the framework?
It's related to the regulation as it is today. The regulation is inspired by Solvency II principle, and Solvency is not a bad regulation per se. It's a regulation that is based on the assumption that volatility of the valuation of assets is a good gauge of a risk. And that's true if you have to manage money on a short-term basis. For example, if you have to send back the money to your clients whenever they want, obviously volatility of the valuation of your assets is a good proxy for the risk. If you are managing liabilities like retirement benefits, you are a very long-term investor because people will get their benefit on average in a long time. And for someone who is 20, it might be after 42, 45 years, and you will manage money still for 25, 30 years. So, to use a technical word, the duration of your liabilities is very high, and those liabilities are very stable. So you have time on your side. And unfortunately, the regulation has this very short-term bias, and you are obliged to assess your risk using a value at risk calculated on a one-year basis, which basically is not consistent with the duration of your liabilities. So if we were able to offer a framework to invest in a way that make possible to escape that kind of constraint, it would be a great improvement. And if we consider what endowment have been able to achieve in the States, it's obvious that that kind of approach of investment is delivering a much better return. It's a much better return because you are able to invest more in private equity project, to invest more in infrastructure, to invest more in assets that are delivering what we call the liquidity premium. And it's very bizarre that the regulation as it is today leads to a very paradoxical result, which is that pension funds are in some way doing transformation in reverse. They are using very long-term money to invest in much shorter assets, which is bizarre because we know that the transition will need very long-term patient capital, and we have natural providers of this quite rare material, patient capital.
Sure,
those are pension funds, and we do exactly the contrary of what we should do. You know, the regulation in some way is at loggerhead with what it should encourage. So this whole ill-designed regulation, or not ill-designed, but unfit for pension fund. Once again, solvency is not a bad regulation per se. It's bad to apply it to pension funds because pension funds have not the same constraint like life insurers. For example, in France, life insurance, you can redeem your policy whenever you want. So it means that there is a hidden option on your balance sheet on the right side, and you might have at some point to redeem, to pay immediately on first demand, you know, what you owe to your client. With pension funds, real pension funds, I mean pension funds that will pay an annuity, you know, you don't have that risk. So this is what we should try to change, and I guess the endowment might be, you know, the good vehicle for that.
So to put it in a nutshell, your time horizon you have is between 30 and 50 years maybe,
Yeah.
and you have to invest it for a period of real 1 year or something like that?
Not 1 year, it would be excessive, but you know, if you are investing in bonds, the duration of bonds, even long-term bonds, is much shorter than the duration of your liabilities. The other issue is related to governance and how you assess your performance. There is a link between the two. You know, trustees, you know, are scared to stray away from the pack, from the herd, and you know, taking the risk to have a lesser performance on a 1 year basis is something you don't want to is a risk you don't want to take. And it's bizarre because once again, sometimes a performance per se does not tell anything about the real performance. What I want to say is that, for example, if you are just tracking a market cap index, maybe you are overperforming for very bad reason. It's just because you are taking even more risk than the risks that are already embedded in the index. You know, at some point, we know that on the Nasdaq, 4 or 5 stocks were weighting almost half of the index. So in order to outperform, you had to be even more weighted towards those stocks. So, but you know, that failing conventionally, unfortunately, is something very common. And it's better to be with the whole crowd, you know, rather than to take the risk to stray away a little bit. And the motto is basically to minimize the tracking error. So in a nutshell, you don't know where you go, but you go with all the others. And it's where, you know, having time, it's an advantage. And if you consider family offices or people who are managing their own money, you know, they are able to take that risk. And it's, once again, it relates to the way you assess risk. And we come back to volatility. And it's unfortunate because even the professional press sometimes contribute to that risk aversion between brackets. And I remember an article a few weeks ago, and the title was quite explicit. The Norwegian fund lost $18 billion during the last quarter on its stocks portfolio. Actually, they never, ever lost $18 billion. The mark-to-market value of their stock portfolio decreased by 18 billion. But you know, if you use loss, the trustees understand loss, and they say, "Well, this is very risky to invest in stocks." But you know, it's just a question of valuation. And the stock is up by 1% 1 week, it's down by 2%. And if you are investing for the next 10 years.
Can you maybe give us some numbers? What other strategies like endowments or family office can make in return?
Well, almost the double or the triple of what the average pension fund sticking to the 60-40. I'm not sure there are still many of them sticking to that. But the 60-40 was, delivering not much. It's quite easy to understand if we consider the current interest rate we have in Europe. And so there is some sort of reset of thinking, because obviously it's very difficult to keep on investing as we were used to do. By we, I mean pension funds in govies that are not paying very much, when they are paying something. The 10-year German bond was close to zero or even negative at some point, maybe. So,
with no return.
No return.
What chance does the climate endowment offer then for you?
Yeah, I think the climate endowment, as I said, is, I think, a very unique opportunity to offer to institutional investors that are seasoned investors to invest in a different way, accepting the idea that they will invest for long term, that they will be in for the next 10, 15, 20 years, in order to bring patient capital. And once again, the word patient is very important, because it's not, there will be bumps on the road.
Sure.
But we are talking about a transition. So sometimes you can be wrong to be right too early, but in the long hand, you are right. So if you accept the idea that what cannot go on forever will stop someday, and I think that that's the case with fossil fuels. It's better to start investing in the future rather than to stick to the old pattern. And there is no dearth of fossil fuels on the planet, but as Barack Obama quipped once, we won't burn all that carbon. We could, actually, we could, but
then it's end.
Yeah, it's not. We will not discuss about a 2-degree increase, but about 4 or 5, and because, as it was mentioned this morning during the conference, we are reaching tipping point where it's not anymore a linear process, but something disrupted. So it's the reason why I think this endowment project is so interesting, and I hope it will get traction and support from government and institutional investor.
Do you have something to add to our talk?
Sorry?
Do you have something to add to our talk?
No, I think we had quite a broad review.
Thank you very much for this great
You're
insights
welcome.
and this talk. Thank
Okay.
you.